Our total focus in our newsletter is speculation, not politics. When we have situations where political impacts affect how we speculate, we want to be able to mention that. But I want to make sure that we all know we have no intention of recommending any person or any political party for the purposes of politics. That is not our intention at all. Every 4 years, as I understand it, we get a change in who's the head of the Fed, and that's coming up because it's just been announced on who the president wants to be as the new head of the Fed, which of course goes through Congress, but is very likely to have happen. Why do I mention it? Because it has significant speculative impact, including on such things as interest rates. I have been wrong in thinking that we are going to get a potentially substantial increase in long-term interest rates, such as the 30-year T-bond, which from time to time I've recommended shorting, and really haven't been successful. Why is that? I think the biggest reason is that there's been a series of positive economic events. In my opinion, the whole area of tariffs is one that has resulted in a stronger economy in the United States than so many of the financial analysts had expected. Like in the third quarter, we had the economic growth of over 4%, and it looks like that growth will continue in the current quarter. Those are good things that cause people to say, "Hey, we're doing better." And one of the factors of doing better is saying, "Hey, this makes the strength of the American use of the Treasury debt, which is enormous, but we can carry it because, in part, the economy is growing and so on and so forth. And because we can carry it, why we don't have to push up the interest rate in order to attract the enormous amounts of money. It's over 100 billion per week that the Treasury has to raise. So those factors have caused me to be wrong that long-term interest rates are not going to go up. Well, I still think it's quite possible. Again, last I saw was there's no major reduction in the deficit. I think we're still close to $2 trillion a year. And I think this is right because I haven't looked at the details, but I was hopeful that we were going to get Congress, particularly, of course, in the House, to be cutting the budget in terms of hopefully hundreds of billions of dollars to bring that $2 trillion per year deficit down to something more reasonable. But now it looks as if those high numbers may continue. That gets me to what I have long felt is the biggest problem with keeping interest rates low, which is you got this auction. Several times a week, the Treasury has to go before the buyers, and the buyers are a few small number of investment firms that will be asked to come and say, okay, I will buy 10 billion or 20 billion worth of the upcoming auction at this interest rate. And they put those figures together, and it's not the Treasury that decides what the interest rate is. It's the buyers, or it's, as they call the people who are responsible. Particularly now, I think the money market funds, because they've grown so much in the last few years, to several trillions of dollars, are the ones that are major factors on saying, okay, the interest rate on the auctions is not going to go up, or it's going to go down, or whatever. If that number starts to increase, and the magic number continues to be 5%. If the interest rate on the various auctions pushes up through 5%, then I continue to feel that you would get a reaction in Wall Street, that you get headlines saying, oh my gosh, interest rates are going up, and that would be a cause for us here at the Occasional Speculator to say, all right, we recommend once again shorting the 30-year T-bond. Currently, while we do have an interest rate short position, it's over across the Pacific with the Japanese 10-year bond, the JGB. There, we continue to think the interest rate bear market, or the bond bear market in Japan, which has recently pushed through 2% for the shorter term instruments, like the 10-year, can go much higher. But as far as what's going on in the United States, it hasn't happened, in my opinion, largely because there have been some good economic policy by the current administration. So we shall see, but it's one of the factors that we keep constantly monitoring on what's going on with interest rates. The final thing I would say, again, about interest rates is that, in my opinion, the biggest reason there could be a break in the stock market would be if there were a surge upward in interest rates. And again, we currently have, from my opinion, an overpriced stock market continuing. But if you see a surge in interest rates, then that could be another reason why, once again, we might go into saying it might be time, which we do not say now, to short the stock market. If you want a copy of my book, The Speculator's Mosaic, just check below, or it can also be bought on Amazon.